Hey everybody, welcome to StockAbility Startup. This is lesson number one of a 7-lesson series here, diving right into giving people an understanding, a foundational understanding, if you like, of what's to come in the financial markets. The team and I, between us, have got a lot of experience of teaching people of all different levels in the financial markets. And, so many people over the years have come to us and said, what is the difference between trading and investing? What is a candlestick? What's a bull market, bear market? So, we thought before we even begin the next step of that education, education is a process, not, a one day, one video kind of event. It takes a little bit of time, but if you do it the right way and you get a good solid start, you're going to have a much stronger finish. And that's the idea behind these lessons here, to cut through all the nuts, the bolts, and make sure people have got no fogginess when they're going directly into their education. So here's lesson number one for you. This is trading versus investing, a little bit of the difference between the two.
So it all begins with knowing the difference between trading and investing. And to do that, we have to define the purpose and what our goals are behind them. So as it says here, we trade for income and we invest for wealth. And income and wealth, guys, is two very, very different things. If we break these down, let's just take a look on here. I've always described trading as more of an income-driven process on here. And we define income as this. It's cash flow generated from a market transaction, which is what we call a trade. Net gains from a single trade or multiple trades across the day, week, or month could also be classed as income. And the goal is regular positive withdrawals from the account. Now, remember, I say the goal is there are going to be weeks, days, months where you're maybe down a little bit as well. And that's why risk management is so important. And that will feature in a further lesson in the StockAbility Startup. So if trading's more income driven, investing itself is more wealth driven. And when we talk about wealth, our definition of wealth at StockAbility is increasing the value of a total portfolio of assets invested over the longer term. This could be money that's typically held in some kind of retirement account. So maybe a 401k, an IRA, a TSP if you're in the UK, the SIP, the self-invested pension plan, or any other kind of retirement account that you could think of. This is that money that's being put away, and a lot of people are actually contributing to this. So the goal is contribution and growth for future security, basically. So just like the traditional investor, the trader is looking to profit from the market movement. Their typical approach involves the following. They are going to have a focus more based upon short-term profit. And short-term profit could be days, weeks, months, rather than years like the investor. And depending on the strategy, there can and will likely be opportunities every single day. There is enough movement in the market if you pick the right thing to find opportunities to trade most days. Traders are always thinking about what direction the market is likely to move next. Is it going to go up? Is it going to go down? Is it going to be sideways? These are huge factors in a trader's day-to-day life. And they use an approach using more charts and price to make those more important decisions to buy and sell. This is what we call technical analysis. Now, unlike the longer-term investor, news and economics, they're not really as much of a concern and not factored in so heavily. We call that fundamental analysis. And that's where we're going to get more information from data, news, and companies. The trade is more based on the technical world. Okay, using those charts to make those decisions, because the goal of a trader is typically income and income alone. Therefore, if you're going to use price, timing is going to be key to success in this environment. Now, there are different styles and durations of trading as well. So we can look at daily income, which is minutes to hours. We could look at trades where we're in for days to weeks. We would call this weekly income. Some people call this swing trading as well. And number 3 is monthly income. Some will call this position trading, where you could be in an opportunity from days to weeks to months. The investing methodology is different. Unlike the trader, the investor is looking to profit from the market over a far longer period of time and also willing to sit through those market ups and downs. The typical approach is more like this. They tend to think in terms of years when holding positions, monitoring their performance a lot less often. They rely on a more news-based approach of buying, incorporating that fundamental analysis that we just spoke of. An investor will likely study a company's potential for long-term growth, their future valuation, and they'll also be encouraged to use a typical strategy of buying and holding, the buy and hold mentality. Buy, hold that over the long term, hoping to sell for a profit, in the far out future as well. Because the end goal of an investor is geared towards wealth accumulation. Some of the vehicles that they will typically use are mutual funds and bonds, also sometimes equity funds as well. And timing isn't as much of a big deal, okay? Because, the idea is just get in, hold it, and see what happens over the long term. Now, there are some other things to think about. What other kind of investing strategies would we include on here? Well, long-term buy and hold, bond portfolio management, and also dividend investing is very popular amongst a lot of investors as well. Accumulating a stock, holding it on the long term, and then getting their payout from the profits of the company, which we call the dividend. Well, that's great if you've got a lot of the stock, but not so great if you only have a few shares of it. But it is a very important style of investing that a lot of people like if they've got the capital to buy enough of the stock. So trader or investor is the question. Okay, well, what are you going to be? Well, first we've got to know our environment, and we've got to know how the environment impacts the direct results of the trader or investor as well. So what I'm going to do is I'm going to just show you a couple of price charts. Now, if this is the first time you've ever seen a price chart, they're pretty much self-explanatory. So I'm going to take my mouse here, and the long part along the bottom here from 93 to 2012, there's your time period. And on the right-hand side of our screen, we can see the price. Okay, so time along the bottom, price along the right-hand side. Every one of these bars we call a candlestick, and this shows the price movement over time. In our very next lesson, we are going to go into a lot more detail about how these charts are formed. But for now, just bear with me and I'll show you what we're talking about. So we're going to talk now about the S&P 500, the largest stock index in the world, the daddy of them all, the S&P 500. And we're going to look at a period from 1996 to 2009. Now, you can actually see if we take a divider right here in 1996 and we look at what the market did, we had a lovely movement for, what do we have in here? For about 4 years of 152% gain in the market. What investor isn't going to be happy with that result? Buy and hold does have its merits. But then holding through that, you had the tech bubble crisis of the 2000s, which then saw the market plummet quite severely. We saw a 51% sell-off in that market, a big chunk of your profits given back if you were still holding. Then the market recovers, mid-2002, and then it goes through to late 2007, so 5 years of upward trend, with the market recovering to 105%, and then we all know what happened in 2008. Yep, the credit crunch. Market then sells off almost 60% during that period of time. So from 1996 to 2009, we've got to ask ourselves a question here. We've got 13 years of price activity. But was this a long-term gain for most investors or a wasted opportunity? Because for somebody who may have started investing, let's say, somewhere around here in 1999 and is still holding from this point, they haven't basically made any money for nearly a decade. And there's other costs of fees and inflation and things like that as well. That is not what a trader does. Let's look at the trader on the flip side of that. The trader experience is very different. Now, I'm going to take a smaller period of time here. Let's look at gold, for example. Now, I've just mapped up April 29 to May 13 here. So let's just start from April 29 here. And we can see first gold sold off in the short term here, 3% down, then reversed in early May and actually gained back 2.5%. Then went back down into another sell-off on here as well, this time losing about 2%, only to rally once again. Things like a yo-yo, right? Up and down, 3% to the upside here. We then see another sell-off around the early part of May as well, giving back 2.5%, only to then see in the mid-May, the market push its way back up to 2.5%. Now, what we have there is a 2-week period, roughly, of trading. And we've seen about 15% of movement over that 2 weeks. That's a lot of volatility. Some people are like, wow, I'll be happy with 15% over a year long term. But we've seen the market go up. We've seen the market go down. And all of you are probably looking at those red arrows thinking, well, they're losses, right? Well, not necessarily. You see, a trader has tools in their arsenal to make money on the upside and downside. And if you're scratching your head right now, don't worry. We are going to cover it in one of our future StockAbility startup lessons. But this is potentially 15% of movement on one thing across 2 weeks. That volatility is a trader's friend. They are not worried about it going up or down or sideways. They are just looking for good opportunity. This is an investor's nightmare. This is a trader's dream. Something to think about. Again, know the environment and know the tactics and the style that you're going to approach the market with before you even get into it. So one of the questions I guess we've got right now then in conclusion is, what is the better approach? Which is the better way of doing this? Well, it depends on your goals. So much of what you do is about what you're setting out to achieve as well. Goal setting is a key part of this. Are you looking to profit from income? Are you looking to generate and grow wealth? These are two very different things, and they definitely do set a major difference between the trader and the investor.
So there we have it. Lesson number 1 is done. Now you have a much better understanding of the differences between trading and investing. And one of the cool things about this is once you start to learn more about the strategies and the techniques that we use, you can actually apply them to both. So stay tuned for more. We're going to start to look at some very cool things that will adapt to both the world of trading and investing. One of those things actually is market terminology, and you've got your first glimpse of charts and candlesticks in that lesson as well. So join us next time for lesson 2, which is going to be all about market terminology and chart candlesticks. See you then.